Hello, traders. Welcome to another episode of our free Forex training videos on this YouTube channel, Leading Forex. My name is Kofi, your admin for this channel. I'm sure you will appreciate what we are giving to you out here, because when you compare the content we have here with other YouTube channels, you will see that yes, there are similarities, but ours is a bit detailed. And the practical session is the most important part to us, because all we are trying to do here is to learn and become good Forex traders. And that is what this channel here is all about. Once again, let me take the opportunity to thank all the subscribers, people who have taken their time to be part of this community. I want to appreciate all of you. I love you guys so much. God bless you for making this channel to grow. Now, I will please beg of you to make sure that you like any video that you watch on this channel. Even if you can leave a comment, please like our videos for us. It is in a way to help the YouTube algorithm to notify other traders that we have a content or we have videos like this for you. So it is good that you like our videos, which will help the YouTube algorithm to recognize our videos and then to promote our videos out there to the rest of the world to see the good things that we have on this channel. So please, I'll beg of you, if you wouldn't even have the time to leave us a message, please make sure you like our videos. It will really, really help the videos to grow to a wider audience. God bless you for doing that. Now, this video is going to be the part 41 of our tutorials. In case you don't know, we have two main playlists on this channel. Now, the very first playlist is this one you are watching right now. The video you are watching is actually in the main playlist of this Forex channel, which is Leading Forex YouTube channel. Now, this playlist is called Free Forex Training, Free Forex Training playlist. We also have another playlist, which is for signals. So we have the Forex Signal playlist. So these are the two main playlists you will find on this channel. There are other playlists, but these are the main two that you will find very active on this channel. Now, in the Free Forex Training tutorial playlist, you will find videos from part 1 up to part 41, which is this very video you are watching. And then the Signal playlist is actually our forecast. Every weekend, we provide you a forecast that can be traded when the market opens for a new week. So I will please entreat you to check out that playlist, okay? Every weekend, every Saturday, Sunday of the week, we come up with a video, which is actually a signal or a forecast that can be traded, okay? You can actually trade that by opening a buy or sell, depending on the directions that we will give you. So every weekend, expect a video from that playlist, which is the Forex Signal playlist. You can actually go there and watch our previous videos and see the results for yourself, okay? Check and see whether the previous videos, the signals that we gave, are making profits or not. That will help you to understand the content we are giving out here on this channel for free. So help us to grow by liking our videos, giving us some comments, and also talking about us to others. If you can share our videos with other people, I'm sure they will also get to see the good things you have seen on this channel. My name is Kofi. Now, let's continue from our tutorials. In our last episode, which was the part 40 video, we talked about moving averages. I'm sure you watched that video. If you haven't, please go back on the signal or on the playlist. I mean, go back to the playlist and watch that video. So in the part 40 video, we talked about moving averages, right? We talked about moving averages. Now, we left somewhere, and I want to continue from where we left. So last week, we were about talking about how you can actually put a moving average on your chart, which is your MT4 or your MT5 chart, okay? So we'll go quickly and look at that again. And then from there, we'll continue with the types of moving averages. Today, we'll be talking about the types. of moving averages. And I know you will love what you see today, or the information we're going to share with you today. So please make sure you stay and watch this video to the end. So without wasting my time, quickly, I would like to take you straight to the MT4 so that you look at what or how to put your moving average on the chart. Okay, here we are on the MT4. So today on the MT4, quickly, last week we were talking about how to put your moving average on the MT4 chart. And unfortunately, the video ended very, very sharp. Please pardon me for that. That video ended very sharp and it's kind of whatsoever. Let's leave it there. Now, we are here today to look at that again. So last week, I said that to put out a moving average, there are two main places you can do that. The very first place to do that is going to the navigator panel. So at the navigator panel here, where I'm actually circling, is where you will find all the indicators, both the custom ones and the installed ones. That means the ones you are going to install. In case you have any indicator to install, you are going to find it in the navigator panel here. So that is where you can go look for the moving average indicator, or you can also go to insert on the top menu here. When you come to the top menu, we have file, view, insert, chart, tools, windows, help. So at the insert column, when you click on insert, so let's go there first. You click on insert, you go to indicators, and then the first one at the top here is moving average. It is because we used it the last time. That is why it is still on top of the menu here. But there are a lot of them. Okay, when you go to trend, it's under trend indicators. The moving average is under trend indicators. So when you go to the trend indicators, you will see moving average. So you click on the moving average, it opens like this. Then you choose the period. So in the part 40 video, we explain what the periods are, the number you want to use. So you choose the period, and then we have the type of the moving average you want to use. We have the simple moving average, and then we have the exponential, the smooth, and then the linear. But I told you the smooth and the linear are just subsets of these two, which is the simple and exponential. So the main moving averages we'll be putting on the chart will be either simple or exponential moving average. So if you want to put a simple moving average, which is an SMA, then you leave the method here on simple. But if you want to put an EMA, which is an exponential moving average, then you will choose the exponential. In this case, let's use the simple moving average. So for the position, it must be on apply to close. Okay, apply to close means that it is going to do its reading by taking the candles that closed. Okay, the closed pass of, or the closed prices of the candles. And that is what we all want. So it must be on apply to close. Then you choose the star, which is the color you want to give to the indicator. Okay. And then also, if you want the indicator to be thick, light, or whatsoever, you can choose to adjust that over here. If you want it to appear thick on the chart or very thin on the chart or whatsoever, you can do that here. Once that is done, then you click on OK. Once you click on OK, your moving average will appear on the chart like this. So as you can see, here we have a blue line on the chart right now. And that blue line on the chart is the moving average, as you can see. So that is the 20 moving average we have just placed on the chart. So if you come to the navigator panel here, at the navigator panel here too, like I told you, the moving average indicator is a trend indicator. So you go and look for trend. So under trend, you will actually get it under trend, under T column. T column under trend. Let's look for it. Okay, trend. Yes, here they are. Under trend indicators, you will see average direction, Bollinger Bands, envelope, Ichimoku, moving average, parabolic SAR, and the standard deviation. So we are looking for moving average. So here you double click on it. Once you double click, it will appear like this. And once it appears, it is going to give you the previous details that you used. So the 20 we used this year. So let's assume this time we want to use 50. So you change the figure to 50, and then also you can change the color to whatever color you want to use. Let's say want to use red color. It's still on simple moving average. Once all is set, you click on OK. And then you see the red line also on the chart. So the red line here you are seeing is the 50 moving average. So the blue line is the 20, the red line is the 50. So any moving average you want to put on the chart, this is how to do it. Is that okay? Good. Now, without much ado, I want us to go back to our notes and look at the type of moving averages that we have. And if you agree with me, let's quickly go to our notes and see the type of moving averages that we have. Now, today, like I said, we're going to be talking about moving averages, and we are looking at the types. Now, if you want to contact me, this is how to get in touch with me. My Telegram handle is there at Kofi Dollar. My email, my phone number, my WhatsApp number, all is available for you. Now, Leading Forex, our main motive or vision of being on this YouTube platform is to help traders to become good at what they want to be. If you want to be a good Forex trader, then we are here to help you become a good Forex trader. So we want to become an alternative in the status quo that you are stuck in. We know there are a lot of people who are trying hard to get their way through the Forex market, but it's kind of complicated. So we are here to make it very simple for you. So that is our mission, vision, and our dream. So subscribe to this channel and we'll be good to go. Now, today we want to talk about SMA, simple moving average. And just as I have demonstrated on the MT4 by putting a simple moving average on the chart, now this is another chart we just want to look at. Now, on this chart, you see that we have the 5 SMA, which is the 5 moving average, the 30 moving average, and then the 62 simple moving average. So these are all simple moving averages, and there are 3 of them. And you can see that some is closer to the candles than the others. So you see that the 5 moving average is very close to the chart. And then you see that the 30, which is the yellow line, is next, closer to the chart. And then the pink color, which is the 62 moving average, is quite far away from the, what do you call it, the candles, which is the price. Now, in our part 40 video, we said that when the moving average is very close to the candles or the price, what it means is that that moving average is very small in number, okay? Or it is smooth, but not smoother. The smoother ones are the ones that are very far, and the rough ones are the ones that are very close to the chart. Do you remember that in the part 40? The part 40, we said we have rough moving averages and smooth moving averages. The rough ones are the ones that are very close to the chart or to the candles. So when you see that a moving average is very close to the candles, that means that moving average is rough. And then the smooth ones are the ones that are far away from the the chart or the candlesticks. Is that okay? So in this case, the smooth moving average here will be the 62, followed by the 30, and then the 5. Now, we also said in our previous video that the smooth moving averages, they lag a lot. They delay. They delay in terms of reacting to the price. But the rough ones, they give quick reaction. They give quick reaction. They react quickly to the market price or to the candles. So the smooth or the moving averages that are very far from the price or the candles, they delay a lot in decision making. They delay in decision making. And then the ones that are closer are very quick in giving you decisions. Okay, and we also said that the advantage of these two is that one is close, one is far. And the closer one gives you quick answers or quick decisions. And then the slower ones, they give you slow decisions, or they react slowly. All right. But the good aspect of the slow ones is that they also give you the general trend of the market. They give you the general trend of the market better than the ones that are close to the candles. So the ones that are close to the candles do not give you better picture of the trend. But the ones that are a bit far from the candles, they give you a better picture. So in this case, when you look at the pink color moving average, which is the 62 SMA, you will see that that one is giving you a better picture. It is telling you that the trend is still on an uptrend. This is still very up, because to decide whether the trend is moving up or down, the moving average must be below or up the price, or must be below or up the candles. So in this case, you see that the moving average here, the pink one, is below the price, or is below the candles. This shows that it is still an uptrend. The candles are up there with an uptrend, right? The same way when you look at the 30 is also below the price or the candles, which also tells you that the trend is still on an uptrend. Now, when you look at the smaller one, which is the 5 SMA or the 5 moving average, it is very close to the price. So at this point, yes, you may say that the trend is an uptrend when you look at the 5. But what of here? What of this point here? What will you be doing? You see that over here, the 5 is not able to give you a better decision. Now, again, at this level, the 5 is saying that, okay, it's still an uptrend. So if you are using the 5, whoever is using the 5 might have gotten out of the market at this point, because at this point, the candles are beginning to come below the 5 moving average. So the person might think that, okay, the trend is over, so he will have to exit. But the one who is using the 30 will still say, no, this trend is still an uptrend. So far as the candles are still above the 30, it's still an uptrend. And the person might stay in the trend and will be making extra profits. Are you getting the difference? Now, the one who is also using maybe the 62 will also stay in the market from here all up to this level. Do you get it? So these are the differences. So the one who is using the closer moving average to the price will have a lot of disturbances, because price will react very quickly, and then the moving average will also react very quickly. But if you are using a bigger number, or an SMA or a moving average that is of a bigger number, you are going to see a clear picture or a better picture of the overall trend of the market. Now, in case this is not better or clear, let's continue. Things will get better. Now, let's read some notes for our own understanding. Now, as it is with almost any other Forex indicator out there, moving averages operate with a delay. Just as I said, they move with a delay. They delay because they are taking the previous candles, the closing price of the previous candles. So they will always give you a delay in terms of response. Okay. Now, because you are taking the averages of past price history, you only see the general part of the recent past. That's the point 2. So if you plot a 5-period simple moving average on a 1-hour chart, you will add up the closing. So here they are trying to show us how to calculate, or how the calculation is being done, which will result in the line that you see on the chart, which is the moving average. A calculation is done, and the calculation is done by the indicator itself. So it does its own calculation based on the numbers that you will input into the moving average. The moving average will use that number to do its calculation. So how is the calculation done? So for instance, if you plot a 5-period moving average, what they are saying is that, for instance, on the 1-hour chart, the point 3 is what I'm reading. So if you plot a 5-period simple moving average on the 1-hour chart, you will add up the closing prices for the last 5 candles and then divide that number by 5. Let's look at this into detail, how the moving average does its calculation. Now, there is one problem with the simple moving averages. They are likely to be distorted by spikes. So as when there is news in the market, or when there is any issue of data or an upcoming data, or when the data is released, we'll be talking about this data release and stuff under fundamentals. Okay, that will be under fundamental analysis. So once the news is released, the news can cause the market, or can cause the market to destabilize, or it can distort the market a bit, or it can create noise. The news can create noise in the market, and that noise can result in some spikes. You see some candles, long candles being formed at once, and you don't know why that has happened. All of a sudden, within a minute or two, you will see the price moving in aggressive manner, and you are like, what is happening in the market? Yes, what might be happening is that the market is responding or reacting to a news that has just been released, or a data that has been released. That might be the reason why you are seeing those spikes. So they are saying that the simple moving averages, it doesn't matter which number you put. If you put 50, 100, 200, whatsoever. So far as it is a simple moving average, what they are saying is that they can be distorted by spikes. It means they can give you fake signals by spikes from news or data. Are we getting it? Now, let's continue. If it's not clear, it will still definitely become clear as we move on. So when spikes happen, they can give you 4 signals. You might be thinking that a new trend is forming, but in reality, nothing has changed. So this is the problem we have with the simple moving average. We will soon look at the calculations, but let's look at the problems with the simple moving average. So this is the major problem we have with the SMA. Not all moving averages. We are saying the simple moving average, the SMA. This is the problem it has. So the SMA, which is simple moving average, can actually give you 4 signals as a result of a news or a data that has been released. And we'll look at a practical example to actually back this argument, okay? Now, let's start an example. That's the point 3. Let's start an example to actually back this claim we are making here. That yes, simple moving averages can sometimes be distorted as a result of news or spikes that you will see in the market. Now, let's say we plotted a 5-period SMA on the daily chart of Euro USD. This is an example. So we plotted the 5-period moving average on the daily chart of what? Euro USD. So what it means is that we are going to add the closing prices for the last 5 days. So the closing price for the first day is this. Day 2 is this. Day 3 is this. Day 4 is this. And day 5 is this. These are the closing prices for the last 5 days, because the number you selected is the 5-period moving average. So the 5-period moving average is going to calculate the last 5 candles on the chart, which is Euro USD, which is the pair you have selected. So the 5 days candles are having their closing prices, and we have them here. 1, 2, 3, 4, 5. So what is going to be the calculation that this moving average is going to do? So the 5-period moving average is going to do its calculation like this. Let's look at it. Now, the simple moving average will calculate as follows. So they are going to add all the prices. So all these 5 prices here is going to be added. So this price plus this price plus this one, and plus that one. So it's going to add all these prices, okay? And then the answer it's going to get, it will divide that answer by 5 because it is using 5 days period to do its calculation. So let's see. So the first price here plus the second price, the 3rd day price, 4th day price, the 5th day price. Adding all these prices divided by 5 will give you this result. So it means this is going to be the price, the line, the moving average is going to give you. So if the line was like this, the next 5 candles, you will see the line going like this. So it means the first point is here. The next point, 5 days candle is here. The next 5 days candle is here. So it's going to be joined by a line. And that is the line you see on the chart. But you normally do not see the points. You don't see this point I have put in between. But that is what happens. So the last 5 days candle, this is the point. The next 5 days candles, this is the point, the result. The next 5 days candles, this is the result. So what this indicator is going to do is that it is going to join these results together. And then you will see a straight line. So once you see the line on the chart, it is joining the 5555 calculations that has been done. I don't know if this makes sense, but I'm sure you will understand it. So this is how the moving average does its calculations. So it will calculate the last 5 candles, add whatever price it gets, it becomes a point. It takes the next 5 candles to do its calculation. Whatever is going to be results is going to be another point. So there's going to be a line joining those points together. Then it will take the next 5 candles, do its calculation, give you another point. Then you see the line continuing to join. Do you understand? So you might not be seeing this point that I am actually indicating on the chart. You will not be seeing this point. You will only see a line. So that is how this moving average does its calculations. So the first 5, second 5, another 5. So it becomes a line. Do you get it? Good. So this is how these moving averages do their calculations. Now, this is the calculation we have gotten. And I want you to take note of this answer. And I also want you to take note of this point here. This result that we got from the very first 5 days are days without news. So there is no news in these days. All right, please do you understand? So there is no news in these days to affect the price. So all the prices you are seeing here are original prices from a normal trading days without, or from normal trading days without news. Please do you understand? These closing prices that we've gotten here are normal days without what? News. Are we good? Let's continue quickly before this video becomes too long. Now, let's say the second day. Okay, let's take the same 5 days. Okay, let's take the same 5 days that we just used. Let's say there was news report on the second day. So the first calculation is 5 days without news. The second aspect of the calculation we are going to do is that let's assume on the second day there was news on euro. For instance, today's date is Saturday, 26th of February 2022. Today in the world, there is a major news in the world, in Europe, which has to do with Russia and Ukraine. Russia is currently having issues with Ukraine. And I'm sure most of you know what it is. When you Google, you will see a lot of news around this current happenings in Europe, which has to do with Russia and Ukraine. All right. Now, let's assume that news came up and then that news affected the euro because this news is happening in Europe, which is Russia and Ukraine. So let's assume this news has affected the euro, or, Russia is one of the oil dealers in the world. So let's assume that news has affected oil. But since we are using currencies, let's use the euro. So let's say this news about Russia and Ukraine has affected the euro, and the euro has fallen. Euro has been weakened on the second day when the news dropped. So let's use that news and see what will happen. So on the second day, this was the closing price. Euro on the first day ended at 1.3172. But on the second day, euro fell to 1.30000 because of the news that happened. And then the third day without the news, the fourth day without news, the fifth day without news. So the news only affected day 2. So the price changed. That is why I put it in green. Now, let's do the calculation of the next 5 days with the news and compare it with the previous 5 days without the news. Okay, let's do the calculation. So we add all these days and then we divide it by what? 5. Now look at the result we are going to get here. Okay, the result we are getting here is 1.3163. 1.3163. Let's compare. Okay, let's compare this result with the news to the result of the 5 days without the news. 1.3163 and then 1.3209. Do you see the difference? This one is without the news, 5 days calculation without news, 1.3209. And this one here is 1.3163. Why? Because this 5 days, there's a news that came on day 2. But the previous one, there is no news. So we got this flat figure, 1.3209. And here we got 1.3163. So you see the difference in the price. Now, this result you are seeing is more lower than the first one. This one is 1.3162, while the other one is 1.32. So the one without the news has a higher number than the one without the news. Sorry, than the one with the news. The one with the news has lower figure. If I want to compare the two figures for you to get it well, let's look at it. 3209. So let's do the calculation. 1.3209. This was the result without the news. Compare it to 1.3163. So there's a difference of what? 4 pips between this price here and this price here. 1.3163 and 1.3209. There's a difference of 4 pips. So this one is higher than this one. Do you get the difference? This one is without the news. This one is with the news. So you will see that the news has affected the calculations of the simple moving average. So we are saying that when there is news, the simple moving average can actually be distorted. It can give you fake results because of what? The news. So if that is the case, what are we saying? If that be the case, all we are trying to say is that the second day's results will give you the notion, the one with the news will give you the notion that the price is actually going down, when in reality, day 2 was just a one-time event that caused the poor result of an economic report or news. That is caused by a news report. Do you understand? So you might be thinking that the moving average is saying that the Euro USD is going down because the figures has reduced. And so the line is also going to act in that manner. Meanwhile, it is not really the case. The reason that has happened is because the second day, there was just a news item that came to distort the general direction of the euro. So that doesn't mean that the euro is falling. So the point we are trying to make is that sometimes the moving average is too simple. And that's the point too. The moving average is sometimes too simple. And when we say too simple, I'm sure you understand. Is there a way? Is there a way that we can filter out this news report? Despite this news report, is there a way that we could do away with the news report and still get accurate figures? Because the one without the news gave you accurate report, but the one with the news distorted the results, distorted the calculation a bit, which gave us a different result. So is there a way that we can actually filter out this news noise or this news distortion or disturbances in the market, so that whether the news happens or not, we will be able to get accurate figures? Is there something like that? And that is the point 3 that you see here. The question is, what if there was a way that you could filter out these spikes caused by the news so that you wouldn't get the wrong idea? Is there anything like that? And the answer is yes, there is a way. And what is the way? That way is called exponential moving average, which is the next type of moving average that we will be looking at. Now, I am sure this is getting interesting already. So, first of all, I want you to subscribe to this channel. That is the very first thing I want to ask from you. And then the second thing I would like you to do is that make sure you will subscribe to this channel, because we have interesting content that we will present to you on this channel that I know you will love. Now, today we have just learned that moving averages, we have 2 of them: simple moving average and then exponential moving average. And we talked about simple moving average, and we realized that simple moving average does its calculations by calculating the past candles, depending on the figure that you will put in. So if you put in 20, it is going to calculate the past 20 candles and then give you the average direction of the currency pair. We have come to realize that these calculations can sometimes be distorted by news or data that is released in the forex market. And I gave an example by using the Russia-Ukraine issue. There's currently conflict between Russia and Ukraine. And this will have impact on Europe because these 2 countries are in Europe. So supposing the news comes and then it affects the euro in a day, maybe just for a day, this is going to distort the market. The news is going to affect the market in a bit, in the sense that the simple moving average is going to add whatever is going to be the result of the day 2, which happens to be the news, the outcome of the news that has happened. But we have come to realize that if the simple moving average cannot filter out that news and say that, okay, this is just news that has come to disturb the market. Now it has finished disturbing the market. So let's take it out. Let's not give it a critical look in order to affect our calculations. So what can we do? Is there a way that we can actually get another tool that can filter out this noise that is going to come as a result of news in the forex market? And we have realized that yes, there is a way. And that way is the exponential moving average. And that one, the calculation filters the noise in the market, which happens to be the news that has come to affect the forex market. It will filter out all those news and then give you the accurate figures. But that doesn't mean that it is very accurate. They all have their issues. The simple moving average, we have realized that it has an issue. And then the exponential moving average, which is going to come up next in our lesson, which is going to be our next video, is also going to present its problems. So I want you to take this very critically and then study this very well. In case you don't understand this, I want you to go over and play this video over and over again till you understand this concept, especially if you are going to be using moving averages in your trading to determine the trend of the market. You need to know the difference and how they all have their problems or the challenges they both present. Those challenges will help you to make better decisions if you are using them. Is that okay? Now, let me take you back to the MT4 quickly and put a simple moving average and then an exponential moving average to show you the difference. Okay, so I am going to put a simple moving average of a period of 20, and then I'll put an exponential moving average of the same figure, 20. And then we'll see the results the two will present to us. And that will help us to understand our next video, which is going to be on exponential moving average. So quickly, let me take you to the MT4 right now and then show you a clear example. So I'm going to delete this red line here, which is the 50 moving average. And then this one is the 20 moving average. So let's leave this 20 moving average, okay? Let me change the time frame to 1 hour to make it clearer. So this is GBP USD 1 hour time frame. This is the 20 SMA, is blue. Now let's bring the 20 EMA and see the difference. So moving average, so we're going to get 20. So the period is going to be 20. And then this one is not going to be simple, but exponential. Now, okay, now see the difference. The red one is the EMA, and then the blue one is the SMA. They are all doing their calculations, and you see that they are not on the same line. They are not together. One will ask that, why is it that they are not together? Why are they not on one straight line or moving together? Because this one, if you look at the SMA, it's a bit far away from the price as compared to the EMA. The SMA is the red line, and it is very close to the price than the SMA. So you see that over here, they are all 20-20 moving averages. This one is a bit closer to the price, which is the candles, than the blue one. So the blue one is on top of the red one. If we are looking at the downtrend like this, if you are looking at the downtrend, the blue one is on top of the red one. Over here, if you are looking at an uptrend, over here, you see that the blue one is below and the red one is on top. Do you see the difference? So this is the clear difference we are trying to present to you. You realize that these two moving averages, they are all with a period of 20. The only difference is that one is SMA and then the other one is EMA. The EMA is the red one, the SMA is the blue one. Now, how do you use this to determine trend? If you want to use this to determine a trend, whenever the price or the candles are below and then the indicators, which is the moving average, is above, it means that it is a downtrend. Do you get it? And whenever the indicators are below and then the price is above, then the trend is a buy trend, an uptrend. Do you get the difference? Maybe let me pick another pair that will have that kind of an uptrend. Which pair will give me an uptrend? Let me see. AUD USD. AUD USD. Okay, let's look at it. Good. So look at AUD USD. At this point here, it is a downtrend because the two moving averages are above the price or the candles. And then at this level, it is an uptrend because the candles are all above and then the moving averages are below. So when the moving averages are below and then the price is above, it is an uptrend. And when the price or the candles are below and then the moving averages are above, it is a downtrend. So this is how people use the moving average to determine the trend of the market. So it's either on a buy, that is when the moving averages are below the price or below the candles, or it is a downtrend when the candles or the price is below the moving averages. Do you understand? But the difference here is we are looking at the two types of moving averages. This red one is exponential, the blue one is simple moving average. They are all 20-20, but the EMA is very close to the price than the SMA. The reason is that one is filtering the noise in the market, which is the EMA is filtering the noise in the market, which has to do with the news or any data that will be released to affect the forex market. This EMA is filtering that noise or the result of that news, whilst the simple moving average doesn't care, but it calculates everything. It calculates whatever is going to be the outcome of the news in addition to the days without the news. So you get the two difference of this moving averages. Today, you know what an exponential moving average does compared to what a simple moving average also do. So these are the two differences. So it's up to you. When we look at exponential moving average, in our next video, we will look at exponential moving average, and then we'll look at its problems. Apart from it filtering the news or the noise that the news presents, is there other challenges it also presents to us? Because now we know the problems the simple moving average presents. If you know the problems the simple moving average presents, then it will be good to know the problems the SMA also presents. The fact that the EMA is solving the problem of the SMA doesn't mean that it is the best to use. Are you getting it? So in our next video, we will look at, okay, EMA, which is exponential. You have solved the problem of the simple moving average. Fine. What of your challenges too? What about the challenges you also present? Can we look at those challenges? And then once we look at those challenges, we will come to appreciate and then to understand which one will be best to use. It's either you stick to exponential or you stick to simple moving average. There are others who will also do the combination. They will try to use the two. They will use both the exponential and then the simple moving average together. I don't know whether you want to use them together or stick to one. I cannot tell. So in our next video, it will be very interesting. We will look at exponential moving average and the problems it also presents. Until then, my name is Kofi, your admin for this channel. Subscribe. Subscribe. I repeat, subscribe. And again, let me say this, is if my English is a bit complex to understand, I'm still trying my best to break things down. English is not easy. Okay, so I'm still trying my best to break things down in the English language the way you understand. Even if there are grammatical errors, pardon me, we are not learning grammar here. We are learning Forex. So make sure that you get the details of what we are giving to you over here. But I'll still try my best. To be a best communicator, I must be versed or very fluent in the language. So I'll try my best to always be good in the language I'm trying to express myself to you. So until then, take care of yourself, and I'll see you in our next video that comes next.